is in the news right now is the areas of risk relative to the stock market. There are two areas, general areas. One is the tensions in the Middle East between Iran and Israel. That's one. And that has gone up and it's gone down. Escalated and then settled back down. Escalated, we'll see where it goes. The other is inflation. Interest rates relative to inflation, our debt, and as Peter Grandich yesterday's video said, our immigration issue. Those are the issues that I think face us that put an anchor, a weight on the economy and on the market. We're not in a growth environment. We're not dealing with a growth scenario. Now, we may have spurts of growth, and I hope we're effective enough at taking advantage of those when we have them, but we're not the long-term picture is not yet in place for us to get growth from here. So I'm going to give you I'm going to jump into the dashboards and talk about what's going on. So for 3 weeks, the market has gone negative. Now I want to make a comment that I said in my Tuesday video last week. I gave you a positive view of the market because I do my research on Sunday before my Monday recording, and I play it on Tuesday. So based on what I was seeing from everything I could find, the general tone was, even if we have a few days of negative, the general view at that point was positive. What happened after that was that the market continued to turn negative and more negative, so that by the end of the week, it was decidedly negative. So it looks like to me, what I said at that time and what they said, I was really out of step, or they were out of step. So I guess I owe you an apology for that. But anyway, that shifted. Now, the reason we, in our managing of money, we look at everything daily. We don't make a move daily. We just look at it daily, so that if something changes or the lines cross, we make a decision like that, and we move out of the market or into the market. But when I'm doing these recordings once a week, and I don't have the benefit of making a shift like that, I live with what I said a week ago. So it has turned pretty negative. So there are two things that say this to me. One, these are the top 6 equity indexes plus the long-term government bond index at the bottom. And you can see in the yellow box, this is last week, that the indexes were the NASDAQ down 5%. It's down a total of about 8 or so now, but last week was 5. The S&P down 3, etc. The bond index continued to drop, and it was down 1%. Year to date, the S&P is only up 4% year to date. It was going pretty well for a while. Now it's pulled back. And the other 3 indexes, barely positive, a couple of indexes negative, and of course bonds significantly negative. When you get over to the dots, the green dots and red dots, the red dots are that these indexes are below their 20, 50, 100, and 200-day moving averages. There's a lot of dots. And out of 28 dots, there are 8 that are positive. 20 are negative, compared to 15 that were positive a week ago. So clearly, things as of Friday had started to move in a very negative direction. And I think I said yesterday, earlier last week, we got out of the market. We put client funds in money market. And if the market goes on down from here, it did go down after that, but if it goes on down further, we're sitting where we want to sit, and we'll wait for it to return to a more positive condition before we re-enter the market. That's our approach to it. I don't think that 5% money market is a bad thing, particularly when risk is rising, and it has risen. So, but you deal with you would deal with risk however you deal with it. That's how I deal with it, and we have a method to determine that. Okay, go on to sectors. Now, inside of the S&P 500 are 11 sectors. Those 11 sectors, each one of them is either above its moving average or below its moving average. The 20, 50, 100, and 200-day moving averages, all of them are below their 20-day moving averages. And you can see how they did last week in the yellow box and how they have done year to date. So last week there were three positive: financials, consumer staples, and healthcare, generally defensive. Even some defensive sectors like industrials, materials, those are even negative. So the market really started breaking down. When you look at the year to date in the pink box, there were 8 out of the 11 that were positive, and then 5 that were negative. And the last 3 were very negative: consumer discretionary, telecommunications, and real estate. Telecommunications and real estate has definitely been at the bottom for quite a while. Okay, so here we look at the 18-month chart of the S&P 500, a weekly chart. So 1 move equals 1 week, and you can see over that period of time it's gone up and down quite a bit, and it had risen to a high, and now it's dropped. In the last 3 weeks, it's dropped to quite a bit. You can see that at the far right of the chart. So is it going to push on down below the 20-period moving average? When it drops that fast, my opinion is generally within the next week or two, it may take a breath for a week or so, but eventually it's going to push on down below that. At least that's the way it has worked in the past. So that's a pretty negative view, in my opinion, on the far right. I thought I would take the S&P, and instead of 18 months, I did 2 things to it. One, I compressed it to 9 months, and secondly, I put it into a candlestick pattern. So if you have seen candlesticks, you know how that works. And so this shows that every day or every week for the last 3 weeks, to the far right of the chart, every week it started here and it dropped. Started here and it dropped. And then the third week, same thing, except even more so. So that tells a story that we're in a weak market. And, it seems odd. It would seem odd to me. I won't say it can't happen, but it would seem odd to me if the market took off and went up from here after that much damage. Okay, well, the market this past week was negative, quite a bit negative. What was interesting, the relative strength chart on growth and value shifted also and was very negative toward growth, very favorable toward value. So value type stocks or old economy stocks did well. So that line at the very end of the chart goes down, but it's relative to growth. So think of that inversely illustrated, that shows how strong value was during this time period. When large companies are compared to smaller companies, the S&P compared to small cap, Russell 2000, not much change. You can see at the very end of the chart that it moved down very slightly. So as the S&P came down a lot, so did the small cap. So they were kind of similar, causing the correlation to be approximately even. Now, I've talked about bonds. I am not a fan of bonds. Warren Buffett and I are in the same camp on this one. And you can see it's a 4.5-year chart. You can see the general direction, but you can also see from late December to present. This will take us probably 4 months where bonds have been in decline, in a long-term period of decline. So what that means is, this is the long-term bond, so there are other kinds of intermediate term, short-term, corporate, etc. There's other kinds of bonds, but What this tells you is an indicator for how sick the bond market is. Interest rates are going up. I don't have to tell you that. It doesn't take a brilliant person to know that. And as a result, bond prices are coming down. Why would not financial advisors make a shift in those portfolios? Because they are schooled emphatically by the industry, by the way, that's pushing bonds. They're schooled to buy bonds in portfolios. And as a result, people who use traditional financial advisors, in my opinion, are paying a price for it, because this is what happens in this kind of environment. These long-term cycles that go on sometimes for decades, where yields go up and interest rates go up for a long period and come down for a long period. When interest rates and yields are coming down, bonds are probably a very good place to be. But we're in a period now where the opposite is happening. Okay, the dollar continues to rise. You may say that the dollar, they're printing money like crazy or putting more digits in circulation. As they're doing that, the dollar becomes worth less and less. I won't disagree with you, but we're not compared to that. We are compared against other currencies. So relative to the euro, the yen, the British pound sterling, etc., we are stronger than they are. So relatively, this is a strong chart relative to those currencies. Gold continues to surge. So this has gone on for, what is this, since early February. Gold has, over 2 months, gold has been on the rise a lot. So that doesn't surprise me. I suspect it may take a breather before it goes up more, but I don't know that for sure, because gold does its own thing and is correlated, generally correlated with nothing. Silver, same thing, except silver has gone up even more. Look at that. So this is the spot price. When I put these on a relative strength chart, silver numerator, gold denominator, as it goes up, that favors silver. And you can see the move that silver has made relative to gold. And of course, relative to the stock market, it's gone up quite a bit. Bitcoin has been coming down in the last 3 weeks or so, is still in a decline. Nothing serious. It's still above its 20-period moving average. I do suspect that Bitcoin is going to move on up, but I don't know. Again, it's just an opinion. Volatility. So we've talked about all of the negative things about the equity market, of what the reasons it's under pressure, the amount of pressure it's under, and no surprise that the volatility index has shot up from 12 or 13 all the way to 18. Now, I put my black mark up at 24, my opinion of where this starts to head into danger territory. We're not there yet, but we could get there. You can just see how far away we are. So, but definitely volatility is on the rise. Asbury Research, they measure 6 indicators of the market, and I think this is second, probably third week that it's been, second week it's been all negative, and I think it was partly negative the week before that. Okay, let's compare assets to other assets. So, or types of stocks to other types of stocks. So, high beta, high volatility stocks to low volatility. Low volatility is in favor. Blue chip stocks, defensive, value-oriented stocks versus the broad market, the S&P. Blue chips are in favor. All of this you've seen in the previous charts. The broad market, the S&P, compared to the NASDAQ got hit harder, which means for the last week, the last month, the last quarter, it was more negative or less positive, however you want to say, I think not as negative is the right word, than the S&P 500. Value, as I said, was more in favor than growth, and developed markets more favorable than the U.S., and emerging markets more favorable than the U.S. in the last week, month, and quarter. Government bonds more favorable than corporate bonds. No matter how bad, I just showed you, no matter how bad government bonds are, corporate bonds are worse. And that's measuring the TLT or IEF, exchange traded fund versus LQD. High yield versus corporate, high yield is more favorable than corporate. And short term is more favorable than long term. Okay, U.S. versus the world. This has shifted quite a bit. It's just a few weeks ago that this was very, very favoring the U.S., and it has shifted so that other countries are now more favorable than the U.S. in those 3 time periods, the last week, the last month, the last quarter, including Chile, Peru, Canada, Italy, Germany, Spain, France, UK, Eurozone, Malaysia, Singapore, India, China, and the emerging markets in general. So a lot, South America, Europe, UK, even the Far East. I mean, just a broad range of countries are doing stronger than us. Now, I point out, this does not mean that their currency is better. It does not mean their economy is better. It doesn't mean that they don't have issues or that they have less issues. The stock market in our country and other countries, which is what this is a representation of, sometimes does its own thing for its own reasons. And it may not be correlated, certainly not correlated with the currency, and may not be correlated even at times with the economy. I put the U.S. versus Switzerland on here for a number of weeks. The U.S. has done very well. I kept it on here because I wanted to show you how we're doing versus Switzerland, which is an indication of how we're doing versus other countries and certainly against Europe. So there was a big decline which favored those countries I just talked about, as well as, in this case, Switzerland. Gold and silver. So spot price of gold, as I've said, and silver have gone up. As of past Friday, the increase of gold was 2% over the previous Friday to $23.90 per ounce. Silver, $28.65, an increase of 2.9% over the previous Friday. This brings the gold-silver ratio to 83 to 1, and that's come down. It was up around 90 to 1. If you follow this quite a bit, you know that that ratio is down. But still, it's way in the range that favors silver as a better buy over gold. A monster box of silver, this is bullion, which is just silver, generic silver, rounds, 500 of them in a monster box. This is what it looks like, is $14,940. And that includes a $1.23 markup per ounce. So when you put the markup on a 500 round monster box of silver, it brings the total price per round when you buy it in a group of 500 to $29.88, almost $30 an ounce. And for 20, it's 50 cents more. So for one tube of 20, it's $30.38 from my son Preston. In Proverbs, in the Bible, Proverbs 22:3, a prudent man sees danger and takes refuge, but the simple keep going and suffer for it. I'll leave it at that. When you think of inflation, I saw this chart, I wanted to share it with you. This compares prices on the McDonald's menu from 10 years ago to today. Now, this is not, you may not eat at McDonald's, okay, but it's just an indication of the level of prices that have gone up and sometimes crept up and up and up to the point where they are very significant. So I'm not going to read these to you, but I'm just going to let you look at those first three columns, 2014, 24, and the percentage change. Isn't that amazing? Now, we all go to the grocery store. You do and I do. And you can see these same kind of things. But over time, we forget how far we have come in the price of food from where it was just 10 years ago. But I thought this was an indication of how significant that is. In many cases, approximately double. Thank you for watching. If you have questions or comments, leave them in the comment section below.